Okay. All right, we're going to get started. So just make sure you sign in. So scan that barcode real quick. I'll give everybody a chance to do that and get signed in. And then we're going to get started because there's a lot of info to cover today. Today, we're talking about the different loan types and just comparing them, pros and cons, intricacies of them. And so there's a lot of information in this session. So I want to make sure we get through that.
Oh, I don't.
Yes.
Can I sign in if I haven't it's me not to do anything until I get this.
You should still, yeah, because it gives you a drop. Does it give you a drop down of names or do you get to put in your name?
It said to add your name.
We'll hit that.
Yeah, you can do that.
Can I do that?
Okay, so make sure you sign in and now we're going to jump right into the material. Okay, so today,
Foundations
like
today?
I had stated, we're talking about understanding the loan types. We're looking at the common loan types, first of all. Then we're going to do just a side-by-side comparison of the highlights of each loan type. We're going to talk about what overlays are. We're going to talk about highlights and disadvantages of each of the main loan types, and then just review some reminders and notes that we need to talk about. So that is the overview for today. We're going to jump right in. So common loan types that you're going to see, and the most common are the top three: conventional, FHA, and VA. Occasionally you'll see USDA, and then some of the other ones you'll see are the 1084, which are the Native American loans, the 203K loans, which are rehab loans, land loans, construction loans, private financing, adjustable rate loans, and jumbo loans. So the bottom ones, you don't typically see a whole lot, but you need to have an idea of them. So this class is going to focus on the top four. And then, we can have side discussions on the other ones. And I am also going to send you guys a link where you can kind of get some information on those other ones as well. But I really need you guys to know those four inside and out, okay? Because the bulk of our business is going to be in those types of loans. Okay, so this is a very high level overview of each of the loan types. So did you guys know that each loan type typically has a max loan value? Those loan types, they change year to year. So for example, conventional loan for 2021 is $548,250. Last year, it was about 35 grand less than that, okay? So every year or every couple years, they do make adjustments to these loan max values. And that is based on inflation and things like that, where they make those adjustments. So $548,250 is your max loan amount for conventional. FHA, max loan amount $356,352. VA has the same as conventional, but they also now, as of I think a year ago, started a new product called the VA Jumbo loan. And the VA Jumbo has no max amount. So you can technically get a VA loan for whatever amount you want, as long as you meet the qualifying criteria for that amount. And this is a little scary to me, obtain 100% financing. So you could buy, if you qualify income-wise, you could technically buy a VA loan, $5 million house with no money down. You have to meet the income requirements and the debt to income ratios, but you can. Okay, that's a little concerning, but it is available. Okay, and then the next one is the USDA loans, and USDA loans are capped by income. So they don't necessarily have a loan cap, but you can only make so much to get a USDA loan, and then they take how much you make and determine what you qualify for, and that's how USDA loan caps. Can somebody tell me with the USDA loan, what is the main stipulation for obtaining a USDA loan? I need to make sure this is recording, sorry.
Consider a rural area?
A rural area, yes, that can be a criteria. This is recording. Okay, sorry, I just want to make sure that was recording. Yes, it's rural, specifically mostly rural, right? But it is, USDA loans are used to encourage growth in you can get a USDA loan on. And those geographical locations change. So a house that qualifies for a USDA loan today, whenever they do change those, it may not be in that tomorrow, right? And I'm not saying it's going to change in the middle of your loan program, but you may have done a loan in Mustang and qualified for USDA 5 years ago, and today it wouldn't qualify. Okay, so if somebody tells you, oh, I bought this on a USDA loan and they're getting ready to list it, it may not still qualify. You need to go to your lender and ask them, hey, is this address qualify for USDA loans? You, if you have a house that does qualify for a USDA loan, I would absolutely promote that in the social media and the internet, in the listing, that it does qualify for 100% financing, okay? Because that's very, very great tool, okay? Now, so we talked about the max loan amounts. Now I wanna go back to conventional. So you can still get a conventional loan over 548,250. It just becomes a conventional loan jumbo product, which is a little bit different. It has different requirements. And since they're a little less common, we're not going to go into the details of the conventional jumbo loans, but there are jumbo products, which was one of the ones we talked about on the previous page down at the bottom here, jumbo loans. And not all lenders do jumbo loans. So if you're getting somebody who needs conventional jumbo, you need to make sure you have a lender that can do that, okay? Another one that I didn't put up there that I just thought about is physicians loans. And the reason we don't go into details about physicians loans is because every lender that does physicians loans have different programs. So I've been to one, Arvest, who I have found has one of the better ones that allows up to 103% financing. So they allow them to finance their closing costs into the loan. So they can get 100% on the house plus an additional 3% for any of the closing costs incurred to close on the loan. Other ones will do still 95.5, things like that. So I don't put those up here because those are very lender specific. And even the jumbo loans are somewhat lender specific. So we're not going to go into the details, but there are special loan programs for physicians that you also need to be aware of. And physician loans are not necessarily $1 million houses. I did a physician loan on a $225,000 house because he just finished his schooling. He was stationed here to do his residency at OU. And then that's why he was getting a house here, because he was going to be here for 4 years during his residency. And so he wanted to buy a $250,000 house. He bought it at 103% and finance his closing costs. They do that because they know that they haven't been able to work. They have no job history, and they don't have to have any job history. They just have to show that they are now in their residency and that will allow them to qualify for the loan. So they don't have to have like the job history and things like that. So great programs, but different, very different from lender to lender. Okay.
Hey, Nicole.
For
Quick question on that.
additional loan types. So they don't have a set score per se for conventional.
I'm pretty sure she
And
can't hear
conventional
us.
is typically does have a baseline, but every bank has
Thanks,
overlays.
Kevin.
So we're going to talk about that. Conventional, what we will
It
say
is what it is.
is
Apparently,
always
it's
going
little
to be
things
higher
on this
than
piece.
FHA and VA.
Did y'all
Okay,
see
and
the
it's gonna
place
be
to sign
lender
in?
specific on what their overlays are, if they
Can I
allow
see
the
the what?
minimum, or if they
The
put
place
in
to sign
overlays.
in?
On the FHA, the minimum
She
credit
had it up
score.
at the
Now,
beginning.
these are
but
minimum credit
Went
scores
away real quick.
required by the.
I feel like
by
it's the same
government.
link, but I haven't
Government-backed
seen
loans.
it yet.
FHA and VA and USDA are government-backed loans, meaning that they are insured. If you default on the loan, that they are going to be backed and guaranteed. Okay. Conventional isn't necessarily a guaranteed loan, which is why they're a little bit different product. So 580 is the minimum standard set by Fannie Mae and Freddie Mac. But most banks put somewhat of an overlay on that. They don't loan on the minimum. And again, we're going to talk about overlays in a second, but that is the minimum. So if you have somebody who's struggling to qualify, you need to make sure you have a lender available in your
Closed it, unfortunately,
portfolio
Lauren. I'm
that will
sorry. I'm trying
do
to find
no
it.
overlays on credit score. Okay.
It's
So make
okay,
sure you
thank
know
you.
your lenders and what they require. VA, per guidelines, there isn't a minimum, but most lenders set it at 580. Okay, they have the most lax, the VA has the most lax requirement for being able to qualify for the loan. And then USDA currently has a minimum of 640. And that's because they're qualifying you at 100% financing. And so they have a little bit higher standard because they want to make sure they're going to get paid and not get stuck with full equity in a house. Okay, so any questions on credit score? These are just the baselines of what they are required to have. They can't go, so any bank can never go lower than these, but they absolutely can put overlays and go higher than these. Okay. Okay, debt to income. So can some, yeah, student loans. If you're required to pay child support, that goes into your debt to income, credit card debt. So any debt that you have that you're required to make that monthly payment on, that they take the total of all of that and they divide that by your income, or they take your, they divide that by your income and they get your percentage. So conventional loans and USDA loans typically have the most stringent debt to income ratios.
That's not include your household expenses.
It does not include your household expenses and not like your cable, your electric, none of that stuff, right? This is just your like hard lending debt, right? So on conventional, it's up, it can go down to 45. It's up to 45 with less than 20% down, but the more you put down, then that changes. So it's a scalable deal. The less you put down, the more stringent it becomes, okay? FHA has a 55% debt to income ratio basis. VA, there's a lot of factors that plug into it, but their general guideline is 50%, but there's a lot of other factors that plug into it that can change that. Okay, so that's where the lender needs to run them through the model and see what all their debt is and then how and what their income is and how they qualify. Very important to note when we're looking at this debt to income ratio, it is very easy to calculate when you're a hard W-2 employee. You get a W-2, you have a standard salary, very easy to quantify. If you are a 1099 employee, if you are a heavily bonused employee, if you get cash income, a lot of cash income, that makes this a lot harder to determine. And some of that income can be not qualifiable income. Okay, so unless your bonuses are consistent, like regular and can be predicted, they may not qualify your bonuses towards your income because they're not guaranteed. I had somebody who had child support as part of her income. She received child support, but because he missed a few payments, they weren't able to use they were only able to take what she had received, not what she was supposed to receive, but what she had received and use a factor of that. Okay, so you have to look at the big picture. Okay. But things that kind of throw into debt to income could be if you get disability, if you get, like if you're a veteran and you get your retirement pay, if you get disability from veteran pay and things like that, all that does feed into there. So they do look at all the income that comes in, but some of it may not qualify towards your income. Okay. And then USDA, very strict with the 41%, again, because they're loaning 100% financing. Okay. Now let's talk about minimum down payments. So a lot of people think that they have to have 20% down to buy a house, right? We know that's not true. Most of the time, when you're obtaining a conventional loan, you need to have 5% minimum down payment. Okay, there's occasionally somebody can qualify for the 3% conventional. That's a pretty, like a newer product. I haven't even done a whole lot. I maybe have done a handful, less than 5 of the 3% conventionals. But they are available, but the qualifications are much different too. So you can occasionally get a 3% conventional, but the general standard rule of thumb is 5% for conventional. FHA minimum is 3.5%. Any money down, you can obtain 100% financing on the property, okay? Now, that doesn't mean that you can't put more than that down. Those are just the minimums that you need to put down. Are there any questions around that? A lender in here in a couple weeks to talk about how they process things. Like Cornerstone, for example, if you guys were at the mastermind when Dominic came, I love what he does. Any client that he gets, he will run them through different loan scenarios. He'll run them through what it looks like for a conventional and what it looks like for a VA and compare them side by side so they can see if they do qualify for both, so they can see which one makes the most sense for them. Okay, a lot of good lenders, if they qualify for more than one loan program, will walk them through both and see what they do, what works best for them. I had a client who was trying to buy a house, and the lender had just qualified her for FHA, and she was buying at like 325, 340, something like that, right? And so she loved this house, but with the PMI that came with FHA, it was bumping her payment up quite a bit because PMI for FHA is higher than PMI for conventional. But the lender didn't give her the option for conventional. So when we were getting ready to write this off, she was a little hesitant because we were looking at like her all up number. So I called the lender and I said, is there any way she can qualify for conventional? And she said, yeah, she can. She just needs to bring this amount down, and and we need to get, her payment, or we need to get her, because of debt to income, like her payment needs to be here. Well, I got on the phone with an insurance agent and said, hey, the lenders kind of overestimate when they're doing the debt to income and the factors for what the insurance is going to be on a house. I said, can you give me a hard insurance quote for this particular property? Well, the lender overestimates, and they're saying about $1,900 because they don't know if she's buying new, they don't know if she's buying old, they don't know, what that's going to look like. Well, she was buying a brand new house, so I knew she was going to get great insurance. So I called. Her insurance was only $1,000. So I called the lender. I said, here's the insurance quote. It's $1,050 for the year. Great. Now I said, and she's making 40 grand on the sale of her house. We already have it under contract. She's going to walk with this amount of money. So with that 40 grand, with the $1,000 in insurance, she immediately qualified for conventional loan. It lowered her payment with all of that considered, but almost $300 a month because her PMI lowered, her insurance lowered, right? And so she got into a really great loan. The other thing that we're going to talk about, and this is the bottom one, but is PMI. Anytime you can get into a conventional loan, your PMI, your mortgage insurance falls off at 20%. So with FHA, you have it for the life of the loan. So her payment's going to drop even more in about 7 years when she hits that 20% equity in the home. To say, hey, wait a minute, I think if we put this all together, we can get you so she felt more comfortable with that payment. Okay, so these are things that you guys, if you really know these things, can really save substantial amount of money for your clients. Okay, so those are the down payments. The interest rates, your lowest two interest rates, and I spelled typically wrong. Your lowest two interest rates are on your VA and USDA loans. Because again, they're trying to incentivize you in the USDA program to purchase in those areas that they're trying to expand in. And then VA, they're honoring you as a veteran to, with giving you really good affordable interest rates. FHA rates compared to conventional are definitely lower, but typically not as low as these two. And conventional are higher, but when we say higher, we might be referring to like 0.25% higher or 0.5% higher. They're not substantially higher. Okay. Now, what is one of the biggest factors in the interest rates that a person, like if you apply for a loan, what is the one? Yeah, your credit, right? Exactly. So when you apply for the loan, the interest rates that are set for that day may be 2.5%, right? And then based on the loan type, they crank that up just a little bit, right? And so it might be 0.25% higher for FHA, okay? But then your interest rate could just be at that minimum, or it could be higher based on your credit and your debt to income, okay? So the better your credit is, the closer you're gonna be to that bottom level baseline. The better your debt to income is, the closer you're going to be to that bottom level baseline, right? So just keep that in mind. You could have got somebody an interest rate of 2.75% and send that same person to the lender the same day, and they may qualify for 3.25% because it is for the same exact loan, because it's based on their debt to income and their credit. Okay.
You said it's typically more difficult for 1099 folks. Is that with a bank or a lender?
When I say it's more difficult, I'm saying that they can't, like, if you're going to go on, if I meet somebody in open house and they want to write an offer on that house, and I need to get them pre-qual because they don't have a pre-qual right away, they're W-2'd, super easy to qualify them. They could probably get qualified instantly. If they're 1099, they can plug in their information, but in order for the lender to truly look at what their income is, they need to dig a little deeper and verify that income. Because a W-2, you get a W-2, I can send it to you, it tells you exactly what I made. 1099s, those are independent contractors, they have a lot of write-offs, so they can't just instantly run it and qualify them. It's not necessarily harder per se, but they need more documentation and a little bit more paper trail to be able to qualify the income.
I just met a client yesterday.
Yeah.
So I went ahead and sent them the cornerstone link.
Yeah, I mean, we're 1099, right? So I just know when I apply for a loan, I got to have bank statements for every single bank account. I've got to have investment accounts showing. I've got to show my profit and loss statement. Eventually in the loan, and they may not require it to get the qualification, but before I close, I'm gonna have to provide a profit and loss statement for the business. I'm gonna have to show my 1099, I'm gonna have to show 2 years of tax returns. As a 1099 employee, there's just a bigger book of information that you have to provide to get from point A to point B. Okay, and the lenders and their underwriters will work through that as you're going through the loan process. But they're just, if you have a 1099 employee, a lot of times it's harder to just say, hey, go apply and we'll get you a pre-qual here in an hour, right? They need to do a little more digging to set that pre-qual. And again, the lenders will help you with that and work through that, no problem. Just keep in mind, they're not just rapid fire like some of the other.
I think she said she applied through the bank, and she said we should know the next couple of weeks. I'm like, oh, yeah, we need to know before that.
Yeah, it shouldn't take a couple of weeks. I mean, it should take a day or two, unless it's super complicated and they're going to go track down more information. Okay, so it just adds an extra layer of information you got to provide in your packet. The great thing is we're getting a lender to come in here to talk to you guys, and that lender is Dominic, and he's going to go through what happens in underwriting. What are the things that they typically request? So what can we be preparing our clients to be pulling together so that we're ready to answer the questions and get through the loan process as efficiently as possible. Okay, so anyway, that's what the interest rates look like. I want to spend a minute on PMI. So does everybody understand what PMI is? Right. And so because conventional has the most strict requirements, they only require you to pay PMI or that insurance premium, and if you're at 20, if you don't have 20% equity. Okay. If you're over 20% equity, there is no PMI. So you don't pay that regularly. So with conventional loans, you have no upfront costs, no like initial PMI chunk that you have to pay at closing, but you will have PMI as a fraction, a portion, a dollar value of your payment until you hit 20% equity and it falls off. And this is weird. The banks do it automatically. It automatically falls out off at 22% on its own. So you're making your payments when you hit 22% according to the amortization schedule, and at the initial loan issuance, it automatically falls off. An interesting thing about this is property values increase, right? So what if somebody bought a house a couple years ago, now they're skyrocketing, right? If somebody might not be even close on the amortization schedule to that 22 or that 22%, but the prices in their neighborhood have shot up, so they can actually call their bank and request an appraisal. They'd have to pay for the appraisal, but if they think that they have more than like that 20%, they can request it, and then if they do, they could be 10-year. Say, hey, I think I'm at 20% equity. Can we take a look at this? Pay the appraisal fee. Well, the bank orders it. The bank will always have to order it, right? But and depending on the property, it could be anywhere from $350 to $550. But again, you're paying per month anywhere from $100 to, depending on the loan, maybe even up to $250, $300, right? Yes, because they're the only loan program that it falls off. Okay.
If you bought your home
Mhm.
with FHA,
Mm-hmm.
and then 6 months or a year, your equity has built up, can you then reapply?
You can refinance and go into conventional if you qualify for conventionals. Yes. So that's what a lot of people do, is they'll switch and refinance to a conventional loan, right? But the great thing, like I said, is the bank automatically takes it off looking at that schedule when it hits 78% or 22% equity. But as a homeowner, you can, if you think that it's at 20%, you can request an evaluation and potentially get it dropped off sooner. You can also call them if you don't want to deal with that. You can also just call them when you hit 80% and say, hey, take it off. Most people don't. And so it just automatically falls off to 78%. But people don't know that that's a possibility. Okay. Now, FHA, it's much different. The PMI is on there for the life of the loan, period. Never falls off. So the only time you can get rid of PMI on an FHA loan is if you refinance into a conventional loan. Okay. So it's always going to be there. So like for my friend's case, it was much better for her to go conventional because again, you have PMI for life, and her closing costs were going to drop substantially because she didn't have to pay the upfront mortgage insurance premium. So you have to pay the upfront premium plus a monthly fee, whereas with conventional, it falls off and there's no upfront premium. Okay. VA, there is no PMI, but there is a funding fee. And this funding fee varies, okay? So let's talk about that for a second. What is one way that a veteran does not have to pay a funding fee ever?
That they have
Funding fee is
100%
automatically waived
disability.
for a veteran if they are disabled. Okay, so one thing you can understand about veterans is when they get out of the military, they do their medical assessments and out crossing, they get a disability rating. Okay, they can get 0, they can get 3%, 5%, 10%, whatever percent, right? Well, interestingly enough, if you are 10%, just 10% disability rating, there's never a funding fee and there's never PMI. Okay, huge savings, never a funding fee. Okay, but you can roll on these funding fees, you can roll them into the loan, by the way, on the FHA and on the VA. So they can roll them in the loan. They don't have to necessarily pay them at closing. But again, increase the loan amount. So with the VA, it's very nice. It's 10% disability rating and they never have a funding fee ever. Loan, first time use, the funding fee is lower. Okay, and I'm not going to quote it because it changes every year. But like when I got mine for the first time, my husband was active duty. The first house we bought, it was like 0.75% of the loan. That was our funding fee. We could roll it into the mortgage. The second time we bought a house, he was still active duty, so it increased to like 1 point something. Okay, that funding fee, you roll it into your loan. You don't have to pay it up front. If you choose to pay it up front, the percentage does decrease. Okay, so again, lender will get you that information. Just know the VA funding fee can be rolled into the loan. Never can closing costs be rolled into the loan per se in these programs, but these funding fees or these mortgage insurance premium fees can be rolled into the loan. Okay, and with your VA at 10% disability rating or higher, there is no funding fee. Okay, all right, now for USDA, PMI does stay on there for the life of the loan, and there is an upfront fee for that mortgage insurance. And again, it can be rolled into the loan. Okay, so I want you guys to kind of keep this out. We'll make sure we get you these slides because I want you to be able to reference this. And there's some other good references that were coming up. Okay, so let's talk about overlays. So we talked about back here, these minimums, right? Minimum credit score, minimum debt to income ratio. When we're looking at lenders, there are lenders that strictly go off the minimums. And then there are lenders that you're like, hey, wait, this person has a 580 credit score. Why are you not qualifying them? Well, that's because of overlays. So a mortgage lender can overlay, or a mortgage lender overlay, it's a qualification requirement that's applied by the lender that exceeds the standard qualifications set for that particular loan program. Okay, why they do this? What would be a good reason for a bank or a lender to do this? Exactly, right? Extra protection for them loaning the money. So they put these overlays on, increasing the debt to income, increasing the credit score to protect them, because if they have their people defaulting on their loans, that impacts their bottom line, right? So these overlays are set by the lender. They're very lender specific. Some lenders may have overlays on credit scores, but not on debt to income, may have it on debt to income, not have it on credit scores, or they may have it on everything, right? So know your lenders, know which ones you can send those people that are squeaking through by the skin of their teeth, and know who you can send those to versus you got a solid buyer, you can kind of send them to anybody, okay? Always have your go-to non-overlay lender that you know you won't lose a client because you'll be able to send them somewhere, okay? Okay, so quick, we're gonna go through highlights and then disadvantages of each loan program. So again, highlight for conventional loan, minimum down payment is 5%. They don't have to be at 20%, right? And occasionally they can qualify for the 3%. Max loan amount is higher. So the other ones were 350. And there's no upfront PMI required, that initial premium. Mortgage insurance is cheaper on a conventional loan. So that monthly payment that they're making is less. So they may pay us, not everything is based on your credits, not credit score, but the interest rates, right? Everybody's like so focused on interest rates. Well, you may be getting a better interest rate on an FHA loan, but you go to a VA or you go to a conventional loan, your interest rate may be a fraction higher, but your PMI is lower. So it can offset it and your PMI falls off, right? So we need to understand the big picture. And that's why I love lenders that will walk them through everything that they qualify for and see what makes the most sense for them, okay? Because a lot of times if they can qualify conventional, it's gonna be better in the long run because the mortgage insurance is cheaper and the PMI falls off eventually, okay? Houses do not have to be owner occupied for conventional loans. Okay, unless you go to a private lender, this is really your only option to purchase as an investment property. Okay, because FHA, VA, USDA, they don't allow the purchase to be for investment purposes. Now, could you turn a house that you have a VA loan or a conventional loan into a rental? There's not a minimum, I mean, there's not a per se requirement. You have to buy them initially and occupy them. And you really do need to occupy them, right? And then after that, circumstances change, you want to put it into a rental. So a lot of people, like we're investors that are just getting started, will buy a house on an FHA loan, get it for the 3.5% down, live in it, fix it up, and then turn around and rent it. But they've lived in it while they fixed it up. They got the 3.5% down because it was owner occupied and then turned around and rented it out. Totally okay. But again, the key is they have to live in it, okay? So with conventional, they don't ever have to live in it. The stipulation for that is most of the time when they're buying it as an investment property, they're not going to get the 5%. Okay, that 5% is reserved for owner occupied. So most lenders, if it's not going to be owner occupied and you're buying it as an investment, are going to require probably around 20% down. Okay, but absolutely can go in and get a conventional loan as a rental property. Okay, next one here, you can use conventional loan for condominiums and townhouses without having to deal with the strict regulations. So with an FHA loan, which we'll get to in a minute, they have a set of regulations to be able to qualify for a condominium or townhouse to be able to qualify for an FHA loan. So you can have a person buying a townhouse or condo on a conventional loan and not have to jump through all those hoops. It's a pain in the butt for FHA. I've done it several times and it's a nightmare. Okay, so those PMI, you do have to bring a substantial amount more to closing the 25%. It is a higher credit score, typically around 620. There's not really down payment assistance programs for conventional loans. You might find a couple lenders that have in-house programs, but a lot of the federal programs that they offer, they're not for conventional, they're only for FHA. Down payment is at least 5%. Harder to qualify. Like I said, they have higher credit scores, they have higher debt to incomes. There's no government inspection, so it can be in any quality for a conventional loan. You're not going to get appraisal requirements, is kind of what this is saying. So this is the one reason we're seeing right now, and this baffles me a bit because we're seeing like people are not wanting to accept offers that are VA or FHA. And it's because there's no like government inspection. When they say government inspection, that is, they all go through an appraisal, but the appraisal requirements for FHA and VA have higher standards for the quality. Okay. So if you're listing a house that's in good shape, why would you steer clear of a FHA or VA loan? Because the only difference between an FHA loan, a VA loan, and a conventional loan is that there's no inspection by the appraisal to meet those quality condition standards. See, an appraisal is an appraisal, right? The guidelines to appraise the value of a home are not different for when we're talking about value. There is no difference in the guidelines for FHA, VA, conventional, USDA. An appraisal is an appraisal determining the value. So people say, oh, FHA loans are harder, VA loans are harder. They're not if it's not a house that needs conditional repairs. The appraisal process is exactly the same in determining value. Exactly the same. You should have an appraiser that's doing a conventional loan, doing an FHA loan or a VA loan on the same house. The comp shouldn't be different because the value doesn't change. The requirements to determine value do not change. So people are always misinformed with this stigma that FHA loans and VA loans are harder and they tie it to value. It truly should not have anything to do with that because there is not a difference in how they conduct the appraisal from a value perspective. That is one of the most frustrating things that I hear and see. Value-wise, there should be no difference. Condition-wise is where you can run into some complications because with conventional loan, they don't look at the condition and create requirements to repair. They always take the condition as a factor of value, but they never take the condition in a conventional loan and give you requirements to repair things unless it's just completely like not inhabitable, no running water, those kinds of things, right? So that's your only hurdle. So if you're listing a house that's in good shape and there's not like peeling paint, there's not hazards, there's not broken windows, there's not missing carpet or missing flooring, like why would you deter people don't understand that there's no difference. And I said that too until my husband became an appraiser and he's like, the appraisals are stricter. It's the exact same. They all go by the ANSI standards. They all go by the same guideline for value. It's just that they're looking at things that are devaluing the home, not having flooring, having electrical, safety hazards, things like that. If you don't have railings and the drop off is over a certain height, those are the things that they're looking at. They're looking at structural. If you see cracks and things like that, they're going to call those things out. So if you have a house that doesn't have that, don't be scared of an FHA or a VA program, okay? So with conventional, that is a disadvantage because they're not necessarily looking at those things when they're going to issue the loan. So they're not going to point out, hey, there's maybe some structural stuff here. Or, hey, this peeling paint is going to get worse over time. They don't care on conventional. So it's a pro for the seller, but potentially a negative for the buyer, right? Because they're not worried about the quality. And then with conventional loans, only a portion of the down payment can be a gift. So with all of these loan programs, you can typically get gift funds from family members if you don't have all of the money you need. But with conventional, they do have requirements of only a certain portion of your down payment can be given as a gift fund from a family member or something like that. Okay, so other programs, they can give you way more than that. With conventional, there are limits set on a fraction of the home price. And then the interest rates are typically higher, but again, with interest rates being so low, it's nominal, and with PMI being lower, it often offsets. Okay, well, are there any questions about conventional loans, advantages, disadvantages? No, okay. So FHA, this is a government-backed program. What does that mean? Exactly. They default on the loan, the government will pick it up. The bank isn't stuck with it, right? And it's a really good program for first-time home buyers because they can get in at low down payment, lower interest rate, lower qualification requirements. So it is really great for somebody who's a first-time home buyer. Okay, it's easier to obtain, lower credit scores, lower down payment, 3.5%. They can get a full gift fund money for the entire 3.5% down payment. So there's no caps on that. Okay, if they can get their full down payment from their mom, their dad, their uncle, whoever, right? Now, can somebody tell me about the gift funds?
We're not gonna repay it back.
Did you hear? It has to be a gift, and they will require something for all parties to sign saying we're not requiring you to pay this back. Okay. Now, mom gives you $10,000. What happens? How? Exactly. So their bank accounts that gift fund is coming from is subject to the same analysis as the borrower's bank funds because they need to source those funds. Okay, so mom gives you $10,000, they're going to need a copy of mom's bank statements. Okay, now mom doesn't have to send it to daughter and daughter doesn't have to send it to the bank. Mom can send it directly to the bank and keep it private. That's not a problem, but they have to verify those funds. And those funds, and if they see the same thing with lending, if they see weird deposits, large deposits that don't have consistency or a paper trail, they're going to ask for documentation for those funds. Okay. I mean, I had somebody who sold tires or rims off of their car the week of closing. They took the money, deposited into their account because they were going to use that for their down payment. They didn't capture a bill of sale. So they were like, well, we don't have bill of sale for that. We just sold the guy our tires and took money. So right before closing, we're running around getting a bill of sale. And then they need to make sure that bill of sale wasn't just fabricated because of that. So then we had to pull where he posted it on Facebook to sell it. And then that person respond and create the true story behind it to verify those funds. Same thing goes with anybody that's giving you that gift fund. If they have a weird deposit that's not a consistent deposit, they're going to have to source those funds. Now I'll give you my example. When I qualify for loans, I have a real estate account. It's my business account. And then I have my personal account. That's our family account, right? So everything I get paid goes into my real estate account. And then every single time I get a closing, I pay myself a portion of it. And then I hold back a portion of it in my business account. So I don't necessarily have to source every single one of those because my bank can look at those two statements and see, okay, every time she's a realtor, every time she deposits, she transfers X percentage, and it's consistent. It may not be every week or every 3 days or whatever, but it's consistent. Now, if you're a realtor and you're only doing 1 or 2 deals a month, you may have to then show your DA to align with that or your transaction list to align with that because it's not happening at that frequency. Okay. So again, with mine, they can see it every couple days. I'm doing this, right? Depositing, transferring every couple days. If you're not doing business at that level, you're going to have higher requirements of documentation to provide. Okay. My husband's the same thing. So it's a pain in the butt for us because he has his appraiser account and he gets checks in the mail every day for appraisals. They don't ever just send like one bank just sends a bunch of them, right? So we're constantly depositing $500, $500. See, we don't necessarily have to show every single one of those and then transferring Okay, but if it's inconsistent, it would be a nightmare, the way that we run the accounts. Okay, so just think about that. And again, that applies to anybody that's contributing to the down payment and anybody that's on the loan, all of their bank accounts. Okay. So that's down payment assistance, or I'm sorry, that was the down payment can be given as a gift. There are down payment assistance programs. Does anybody know what down payment assistance is? Bond money, yes. There's lots of different down payment programs, right? Down payment assistance is, in most cases, money that you get from some government program that is going to give you the amount that you need for the 3.5% down, so that you only have to pay your closing costs. You don't have to pay your down payment. And in most cases, it's bond money or grant money, so it's not, you don't have to repay it, which is great, right? And so like right now, if you know, with how tight things are and it being very hard for people that are not cash heavy to buy houses, if you have somebody who's like, well, I can buy a house, but I don't have money for my closing costs because I just have enough for my down payment. Try to look and see if they qualify for any of these down payment programs, because now if they can take the cash reserve that they have for their closing cost or for their down payment and not have to make a down payment because they qualify for a down payment program, now they can use that cash to pay for their closing costs. And now they don't have to ask for a closing cost and never get their offer accepted, right? So really something to think about there. Okay.
So you said, check into those programs. Are we doing it for them or are we just directing them?
You're directing them to the lender. Absolutely. We do not. I'm giving you this information so that you can have the right conversations and direct them to the right people. We are not advising them programs and sending them to them. Okay. We are educating. We need to know, hey, you don't need 20% down. You only need 5% down. Like, we're here to educate in that. But they get, and when I say slightly higher, like 0.5%. Well, if you're at 2.75, now you're at 3.25. I mean, we did somebody DPA at 3.25, like that's nothing. And now they're getting 3.5% down in their house. So it's worth it, right? And there are like federal DPA programs, there are local DPA programs, and there are even some banks that have their own DPA programs. Okay. So talk with your lenders when you come across lenders. If you get a file and you're working a deal with a lender, have some conversations with them. Ask them what loan programs they offer, what overlays they have, what down payment programs they are available to them. Just have some conversations with them so you can see and build your portfolio of who to send where. Okay. The other thing, do we know what reserves are?
Taxes, insurance.
That's escrows. What are reserves?
Money saved.
For what? These are reserves. So not down payment money, not escrow money.
Just to have saved.
Retire.
It's just to have saved. So like conventional requires a certain amount of reserves in the account to show that if you didn't have money incoming for X amount of time, that you have reserves in your account to cover, and every lender's different, 2 months worth of your bills, 1 month worth of your bills. With FHA, they don't require any reserves. They just need to know you have enough money to buy that house and they don't care. Okay. Conventional, they need to know you have enough money to buy that house and you have some reserves in your account that if you lost your job tomorrow, you can at least float your mortgage for a couple months.
Because it's not government backed, so if something happens, they want you to be able to pay.
Right, right. Okay, minimum credit score at the 3.5% is 580. I have seen some lenders go below 580 on FHA if they were putting more money down. Okay, but the minimum is 3.5%, is 580 for the 3.5%. And then again, it has to meet the minimum condition So there's less potential for upfront repairs, yes, right? So this is where it becomes a positive and a negative type thing. And then there's lower interest rates than conventional mortgages. The disadvantages of our FHA loans, they require the homeowners or the purchasers to live in the home. So it has to be an owner occupied property. The mortgage insurance premium is required if they're putting less than 10% down. And in some cases, they don't even waive it at all. Like if you go into an FHA loan, some lenders will waive it if you're putting over 10% down for FHA, but in most cases they don't. There are a few programs that they will waive it, but in most cases it's just required and it's there. And then the mortgage insurance costs are higher. The monthly fees and the upfront fee are higher for FHA loans. They do require a licensed inspector. Now, I really want you to understand the wording of this. It's not necessarily an inspector. It's your appraiser who inspects the condition based on the FHA guidelines. It's not a secondary inspector that goes out, okay? So if you're qualified to be an FHA appraiser or a VA appraiser, you are appraising the home and inspecting the home for these conditions. Like your inspector does to make sure that there's no leaks. They're not testing the air conditioning system. They're going to make sure it works, turn it on, turn it off, turn the heat on, but they're not like inspecting it, that it's outputting at the right temperatures. It's a very superficial inspection. Okay. You still need a home inspection with a licensed home inspector on any of these. Okay. And then this loan amount actually is off. That's the old loan amount. So that was last year. So you can see how much it's changed. I got to update my slides. So that is up to the 350 something now, 354. So I got to fix that. And then condominiums. This is where I was talking about condominiums and townhomes require special approval. So if you have somebody who's an FHA borrower that wants to buy a condominium or townhome, it's exhausting. They require the condominium or townhome to be on the FHA approved list. If they're on the FHA approved list, then it's pretty straightforward to do, but a lot of them aren't necessarily on there. So if they're not on there and you want to do it, they are going to get into the condominium association's books, see what their finances look like, make sure the condominium association has enough reserves. They look at their rent roll, not rent roll, but their HOA roll, making sure people, they can't have a certain, like over a certain percentage of people being delinquent on their HOA dues. And they can only have a certain percentage of rental of units being rented. So investor owned units, they have to be at like, I think the last time I checked, it was like 90% have to be owner occupied and only 10% can be investor occupied. So on the flip side, what if they're buying conventional? You have a person who's buying conventional, wanting to buy a condo and use it as an investment property.
As long as the HOA allows rentals.
But you're representing that buyer. They tell you, hey, I'm gonna buy this as a rental. You work with them. I mean, when you buy that condo and then afterwards they put it up for lease and the HOA calls and say, hey, we're at 10%, we can't lease any more units. And now they're stuck with a unit that they can't lease. Right? So if you know somebody's buying a condo for an investment purpose, you need, because conventional will allow you to do so. Cash will allow you to do so, but your client's going to be pretty pissed at you if you didn't help them to understand that we need to verify that you can lease this out, that there's no restrictions. Okay. So make sure if you're dealing with condos that we're getting with them, looking at the covenants, restrictions, verifying like, hey, if we buy this, can he rent it out? Okay. They say they take longer to process. I will say in a lot of, with a lot of our good local lenders, it may be a little bit longer, but not, FHA and conventional are not terrible. VA is the one where we're seeing the long lead times. But most lenders that can do conventional can do FHA, so there's less delay. The only time you see a really long lead time on conventional or FHA is in like more rural property, more rural areas, because those are harder to get an appraiser to pick those up. Okay. So are there any questions on FHA? Okay, VA. So again, no down payment required. You don't have to have perfect credit. Even if you've had a bankruptcy, the requirements to be able to requalify to get a VA loan are a lot shorter than if you're trying to do an FHA or conventional, okay? You can get approved with more debt than any other mortgage program. They're the lowest interest rate, and because of the VA requirements, they cost a lot less in closing costs than your other loans. Your closing costs on VA loans are typically a lot cheaper because the VA restricts how much lenders and title companies can charge in their closing costs. There's never any mortgage insurance. It does have to go through the appraiser's inspection, so you know that there's not going to be a lot of visible damage or hazards to the house. There's lots of flexible refinance options with VA. So, I mean, there's tons of refinance options. We're not going to get into that here, but there are a lot of refinancing options here. You're able to borrow more than any other loan program and have no down payment. So again, there's not the caps on the VA. You can get 100% financing, and you can roll the funding fee into the loan. And with VA, there's tons of mortgage relief options because it is the most heavily backed government loan. And again, there's tons of relief options available. The other cool thing about a VA loan is it can be assumed by somebody else. Does anybody know what that means? What you see when you input listings, like, is the loan assumable, yes or no? Take over the loan, right? So interest rates are great right now. Say we wake up tomorrow and interest rates are 5-6%. And you have a house that you're listing that's at 2.5 or 3%. That borrower, as long as they qualify, they're VA eligible, so they have to be a veteran. They could assume that loan and keep that interest rate. Now, if the house is 250 and the mortgage is at 200, they have to come up with that $50,000 because they're only assuming the loan, but they're getting it at 3% versus the current interest rates, which could be much higher. Okay.
The person that's leaving, then they get to keep that 50 in equity.
No. Oh, no, they're going to get, so the seller's going to get that money because they have to pay the $250 that it's sold for, but they don't have to get a loan for they get to assume the $200,000 loan. They just then have to come up with the cash. So the disadvantage to assumable is that they have to bridge the gap somehow between the current loan amount and the purchase price.
So possible second mortgage.
Potentially, yeah. Yeah, if they qualify, they can get a second mortgage for those types of things. Like lenders just work with them on that. They have to be a veteran and qualify for a VA loan. But it's a great tool. Not necessarily right now. Nobody's going to assume a loan. They're just going to go get their own loan right now because of the interest rates. But if that person tries to resell in 10 years from now and interest rates are higher and they're at 3%, that's a great option. Okay. Disadvantages. The VA is required to pay, or you're required to pay the funding fees. That's the one-time payment to lower the cost of the loan. But again, that is not in place if they are a disabled veteran. They consider the total cost of the loan compared to the total cost of the house. And that's what determines the funding fee. And so you can finance more than 100%, right? If you're rolling your funding fee in, that could bump your loan up to 102%, something like that. And then if you're buying a manufactured home, you still can get a VA loan, but they do require extra they do require some down payments and some protections on those. And then you cannot use VA loan to purchase a rental property. Now, you can use a VA loan, a home that you have a VA loan on as a rental property if you've owned it and occupied it previously. I have our house in the Grove that we lived in for 5 years currently as a rental property. That is totally okay. I even was able to do like this refinance, because where it said on the previous slide, there's lots of refinance options. I actually was at like 4.5% because we had an original loan on it. I refinanced it last year for 2.75% on a VA loan, even though it's not owner occupied. So they have really great refinance programs for VA loans. Now, people have the misunderstanding that I've already used my VA loan. I can't do it again. You can use your VA loan 100 times if you choose to. If you're not disabled, that funding fee does increase a little bit, right? But you can use the VA loan as many times as you want. I did not know this until 2018. There's a secret little thing called plus up eligibility with VA loans, because I really wanted to buy the house, my new house that I was buying on a VA loan, but I wanted to buy before I sold, and I didn't want to, I wanted to have a smooth transition. So I was like, well, we're most likely going to have to buy conventional because our VA loan is already in use on this house and we didn't want to sell it. And my lender was like, oh no, there's this thing called plus up eligibility. And you will never figure out the calculation. I will never figure out the calculation, but they look at your income, they look at your years in service, and they determine how much additional VA lending you can get. And it's based on the VA max loan amount, that cap before it goes to a VA jumbo. So like that 580 something or 550 something. But I had a $220,000 loan. And then I was able to, on my current house that I was keeping, and I was able to use plus up eligibility and purchase my next house that was 340. And all that I had to do was not cap out at that 550, whatever it was. So I just had to pay money, but I didn't have to sell my other house. I could keep it as a rental on a VA loan and still use the plus up eligibility. So you can actually have more than one VA loan at one time with the plus up eligibility. Okay, so those are things, again, you're never going to calculate, but if somebody says I have a VA loan currently, you can say, well, you might still qualify for VA. Let's get you with a lender and see if you qualify for plus up eligibility. Don't try to figure it out yourself. Okay, but something that you can, again, advise them on to go to the professional to see what they qualify for. Okay, USDA loans, no down payment. You don't need perfect credit, but they do have a higher credit score. So like you could have blemishes on your credit in the past that haven't fallen off yet, and still qualify. You can get approved with a little bit more debt than some of the other programs, the lower rates, and lower loan costs. Oh, this is a mess up. Disregard this slide. This copied over the VA stuff. Disregard this one. We'll get to USDA in a second. Okay, disadvantages to USDA. Geographic restrictions. You cannot get a USDA loan anywhere. It has to be on a rural property or a property that they're trying to stimulate growth in that area. Okay, so again, it could be in a USDA when they bought it 5 years ago and they could currently have a USDA loan. That doesn't mean when you're listing it that the buyer can use a USDA loan on it. We have to see if it's still in that USDA geographical region. Mortgage insurance, that upfront fee is charged, but it can be financed into the loan, and there is PMI for the life of the loan. There are very specific can make a qualification, like you can't make more than $150,000 if you're a family of 5. Okay, so then what they do is they take that and then they look at your debt to income ratio, and then they determine how much your particular max loan amount is. Okay, so they look at all of that to determine the max loan amount per individual. There's not an umbrella max loan amount. It can only be used on single family homes. You cannot buy duplexes with it. With FHA, VA conventional, you can buy multifamily homes. And then it must be owner occupied only. Okay, so I just included these so you guys could kind of copy these or screenshot these when I send this to you. This is like each of these. This is a conventional loan, pros and cons. This is a FHA loan, pros and cons. I'm not going to repeat this. This is all the things that we just talked about, but quick graphics that you can kind of save on your phone so that if you're in a pinch and want some references, you can use these. So you'll get this and I'll have Diana post these slides after I fix those couple things that I need to adjust. Now, notes and reminders. This website here, hopefully let me click on it. Yes, this website is phenomenal. I would bookmark this and use it every day. So this, where you're gonna go here, when you get on here is buy a home. Okay, this top link here, and then here's where it defines all of the different loan types. So I'm just gonna click here to get into this portal. What? Oh. Okay, let me go to Zoom. Where's my Zoom? Where's my Zoom? Okay, I'm in my Zoom here. Okay, let me screen share, desktop share. Okay. Now you guys can see all this, right? Okay. Why is it not coming up on there? Stop share. Screen share, desktop. That is so weird. It's frozen up there. Online, for people online, what can you guys see?
I'm not sure if you can hear us yet. Can you hear us?
Anybody?
You can't hear us because of the speakers.
I'm stopping sharing. Okay. Now I can only see you. Okay. I don't know what's this computer. I've been getting errors saying internet's really low. So maybe that's what's going on with that. I'm just going to go here and share this. Okay. Can you guys see the mortgage report? See on here, it's showing on here, it's sharing something totally different. So I'm just going to turn this around so you guys can see this because our internet is doing something funky today. And I'll send this link out to everybody because I really think you guys need to explore this website. So, okay, so on this website, this mortgage reports, we need to first-time home buyer loans,